You've been waiting for the opportunity to get rich in 2025, haven't you? Don't miss it. Because if, starting this year, you still stick to your old habits, working, getting paid, saving money, and leaving it in a bank account without daring to use it, then that's like you're helping a stranger pay off their debts. Not only that, you're helping them pay off debts, but this stranger is using the very money you worked so hard to earn to spend lavishly everywhere. What's the final result? That stranger gets richer and richer, while you get poorer and poorer. Why is this happening? Because this world will once again reverse course and punish those who only save. What does this mean? In the past 4 years, have you received any of the money that the U.S. has printed? You'll realize that even if you didn't buy U.S. stocks that saw massive gains, it's okay, because U.S. housing prices have soared. Even if you didn't invest at all, just kept your money in a U.S. bank, you could still earn 4% to 5% interest annually. What's more, if you did nothing but exchange your currency for US dollars, for example, if you're Japanese and converted all your yen to dollars, what was the result? Your assets passively appreciated by 50%. So, if you converted all your money to US dollars, then bought a house in the US, then used that house as collateral to get a loan to buy US stocks, and then used those stocks as collateral to put money into a time deposit account, you would have received the maximum amount of money the US has printed in recent years. But this approach will completely change starting this year. For the past 4 years, the Biden administration played the high interest rate card to attract US dollars from all over the world back to the US, increasing asset values here. But in the next 4 years, the Trump administration is expected to reverse this strategy. He wants to lower interest rates and devalue the dollar. At the same time, he wants to boost spending, expand significantly, and go on a crazy shopping spree. Recently, he even announced he wants to buy Greenland. So where will the money come from? Part 1. The harsh truth about saving. You're being fooled. In our previous video, we saw that global capital is currently flowing into the US, but most of it is being used to buy US stocks, not US government bonds. This means that those who own stocks, the capitalists, will profit, while the U.S. government, the issuer of bonds, will not. For example, Warren Buffett can sell stocks and hold the largest amount of cash in history, while the U.S. government currently only has about $7 trillion in its treasury. However, every month, the amount the government spends exceeds its income by $200 billion. At this deficit rate, the money in the treasury will run out around April or May of this year. Even so, the U.S. government never runs out of money to spend, because they always use one single method. The Federal Reserve will turn on the money printer, print more dollars, and buy U.S. government bonds. This happened in 2009 with $2 trillion, and in 2020 when Trump was president with $5 trillion.
Every time money is printed, more money circulates. The currency loses value, causing inflation. For example, if I borrowed $10 million from a bank, when the money loses value, I still repay $10 million, but the real value is only $8 million. Meanwhile, if you deposit $10 million, the real value of that money will also drop to $8 million. This lost $2 million is a transfer from you to me. Isn't this like you lending me money and even helping me pay off my debts? The U.S. currently owes over $30 trillion. How will they pay off this debt? Exactly this way. If you lend the U.S. government $10 million for 10 years, after 10 years, they will repay you both principal and interest. But the real value of that money will only be $8 million. This means that $10 million that could once buy a mansion can now only buy an ordinary apartment. Therefore, starting this year, if you earn money and just leave it sitting there, doing nothing, that money you earned will belong to someone else because it will be invisibly transferred.
If you want to protect the money you've worked hard for years to earn, don't want to be a pawn or a victim in this game, and even want to seize the opportunity to make your money grow more and more and overcome social barriers, then you can follow my channel. In the future, I will share more useful information with you. If you're afraid you'll forget after listening, essentially wasting your time, you can like this video. This way, the video will automatically be saved to your playlist, making it easy for you to come back and follow along.
Part 2. U.S. Bonds, the unexpected trap of the elite. First, everyone needs to be mentally prepared that money printing will become increasingly common. In the past, it might happen once every few decades, but now this cycle has shortened from every 5 years, then every 3 years, and now it's just every 2 years. That means, starting this year, we need to prepare early to face a period of high inflation. What does this mean? How do we invest in UST bonds to make money? When I was in college, my professor taught that when the economy is doing well, we should buy stocks because companies will earn more profits, leading to rising stock prices. When the economy is in recession and companies are losing money, we should switch to safer assets, such as US bonds, because they are the safest assets in the world. This is like lending money to the US for investment. As long as the US doesn't go bankrupt, you are guaranteed to get your money back. Therefore, in the past, people bought US bonds when the economy was difficult and most other assets were declining because US bonds could still provide stable interest rates. US bonds were considered an insurance asset like homeowners insurance. When you buy insurance, the goal is not to make money, but to protect the value of your assets in case your house burns down, helping you not lose all the money you invested in the house. Risk hedging assets, like bonds, are meant to protect capital.
But if you look at the price of 10-year U.S. bonds, you'll see that over the past 20 years, their price has continuously increased. What does this mean? It seems my college professor will have to reevaluate his lectures because whether the economy is good or bad, U.S. bonds are still sought after. For example, in 2020, when the market was at its most chaotic, U.S. bond interest rates were less than 1%, but their price reached a record high of $140. This means that if you bought a U.S. bond for $100 with a 1% interest rate, you would receive $1 in interest each year. However, because too many people were competing to buy U.S. bonds, their market price rose to $140. If you wanted to buy this bond from me, you'd have to pay $140. But when the bond matured, you would still only receive $1 in interest. That means when you pay $140 to buy this bond, your actual yield will be less than 1%. To double your investment, you'd need to wait over 100 years. This is a lower return than any other form of financial investment or insurance. However, over the past 20 years, countless people have rushed to lend their money to the U.S. through U.S. bonds. Why is that? It's very simple, because U.S. bonds can increase in value. When I buy at $100 but sell to you at $140, I've made a 40% profit.
This means that over the past 20 years, people buying U.S. bonds weren't just doing it to hedge risks or earn a little interest, but to speculate, just like playing the stock market, profiting from the increase in bond prices. Since the dot-com bubble in 2000, the Federal Reserve, FED, has cut interest rates 11 consecutive times from 6.5% to 1%. U.S. bond interest rates also fell, causing bond prices to rise. Because previously, the bond I bought for $100 had a 6.5% interest rate. But now newly issued bonds only have a 1% interest rate.
If you want to buy my 6.5% bond from me, you'd have to pay $120. Therefore, the market price of bonds increased from $100 to $120. This means that the lower the interest rate, the higher the bond price. Since 2000, the U.S. has used low interest rate policies to stimulate the economy, and as a result, bond prices have continuously risen. Everyone rushed to buy bonds because when they sold them later, the price would increase. Especially after the 2008 financial crisis, bond prices saw the biggest surge because the U.S. not only cut interest rates but also launched its first money printing program. Similarly, during the COVID-19 pandemic in 2020, the FED printed money again, and bond interest rates were only 1%, but still, many people scrambled to buy. The reason is that people believed that in the future, the U.S. would definitely face a crisis, and every time there's a crisis, the U.S. has only two ways to handle the economy. First, cut interest rates, and second, the FED expands its balance sheet, prints money, and then uses that money to buy U.S. bonds, meaning lending to the U.S. government. Whichever way they choose, U.S. bond prices will rise, and bondholders can sell to profit.
Those who invest in bonds often use financial leverage. For example, if I buy $10 million in U.S. bonds, I can use them as collateral at the bank to borrow $8 million. Then, I continue to use this $8 million to buy more bonds, repeating the process. So even if bond prices only increase by 5%, thanks to leverage, the actual profit can be up to 50%. In the past, when buying bonds, we feared that an economic crisis wouldn't happen, because if there was no crisis, the U.S. wouldn't cut interest rates or print money, and bond prices wouldn't rise. This is like buying fire insurance for a house. People who buy insurance don't necessarily fear their house burning down. On the contrary, they hope it burns down soon so the insurance company pays a large sum. Then they can use that compensation to buy a bigger house. Similarly, U.S. bonds are like house fire insurance. In the past, buying bonds was for risk hedging, but now people buy them to make money, and this profit comes from the extra money the U.S. government prints. So, what's the truth about this world? Why does the U.S. government have to print money, and why does economics say inflation is good? People say rising prices are a sign of economic development. But let's think, what would happen if prices didn't rise? That would mean people only need to earn $1 million to retire, just $500,000 to buy a house, $100,000 to buy a car, and the rest can be used gradually.
Part 3. Exposing the dirty trick, the secret behind inflation. Look at Japan. Their prices have hardly increased, and life remains stable. Except for Tokyo, most real estate prices in other parts of Japan have declined in the long run. So Japanese people are gradually accepting a lying flat lifestyle. No competition, no striving, and feeling content with life. But the problem is, if more and more people choose to lie flat, who will work? Who will strive to make the country better? Japan's economy has been stagnant for the past 30 years because of this. From the perspective of those managing the country, they are forced to devalue the currency and push prices higher. This encourages people to withdraw money from banks to spend and invest, because one person's spending becomes another person's income. If everyone keeps money in the bank, society will lack circulating money. At that point, business owners will have no one to sell to, and where will the money to pay employees come from? If the people don't spend money, the government will print money to replace them. They will lower interest rates and at the same time trigger inflation, making all living expenses like food and housing more expensive. This forces you to spend money now, because otherwise that money won't be worth enough to spend later. Inflation basically encourages people to consume and invest. From there, the economy begins to circulate and wages can increase accordingly.
However, does reality actually match theory? When prices rise, do your wages truly keep pace? And even if they do, does that increase keep up with the rate of inflation? How many people who could afford to buy a house 10 years ago but didn't can still afford to buy one now? When the Fed prints unlimited money, in theory, this is injecting more money into the market. But how much of that money actually reaches your hands? Most of this money is lent at low interest rates, prioritizing large capitalists. These people use that money to push stock prices higher, attracting small investors to participate. Then, they sell off stocks or short sell, pull their money back to safety, and continue to wait for opportunities to buy at lower prices. That's why the stock market is where money from US money printing is attracted. If money doesn't flow into stocks, inflation will drive consumer prices up to uncontrollable levels. At the same time, the stock market is also a tool for the rich to transfer the hard-earned assets of workers into their pockets in the fastest way possible. This is the essence of finance. Why can the US get rich through finance? Because this world doesn't need to create new wealth. It's enough to transfer and seize existing assets from others.
But what's the next problem? The Japanese government is not only the first country in the world to promote money printing, but they also lowered interest rates to minus 0.1%. This means if you deposit 1 million yen in a Japanese bank, after 1 year you will only have 999,000 yen. Not only do you not receive interest, but you also have to pay a 1,000 yen management fee. Isn't this very contradictory? Didn't lowering interest rates and printing money lead to inflation? So why isn't Japan experiencing inflation? This is exactly why assets in the US can continuously increase in value in the long term, because the US is playing dirty and Japan is their cheating software. What do I mean? Currently, inflation in the US is very serious, and their debt is also enormous. If the US prints too much money, the US dollar and US government bonds will become worthless. But if they don't print money, no one will buy US stocks and bonds. The solution is very simple. Use the cheating software by letting Japan lower interest rates and print more money. The new money printed in Japan will be borrowed by American capitalists at extremely low interest rates to invest in US assets. This means that the money printed in Japan ultimately doesn't circulate in the Japanese domestic market, but flows to the US. In other words, Japan is helping the US print money. Do you understand this cheating software?
For this reason, even if Japan prints money and lowers interest rates, the amount of money in the country doesn't increase. On the contrary, many Japanese even exchange yen for US dollars to invest in US assets. When many people sell yen to buy dollars, the yen will depreciate, and Japanese assets will also depreciate in the eyes of Americans. But because the money doesn't stay in Japan, they don't experience inflation. A clear pattern emerges. Every time a financial crisis occurs in the US, Japanese assets increase in value, because the capital flowing into the US will flow back to Japan, causing American capitalists to buy Japanese assets cheaply. At this time, the yen appreciates, and Japanese assets also increase. When asset prices in the US hit rock bottom, American capitalists will sell off Japanese assets and return to investing in the US. In recent years, Buffett and many large investors have all played this way. Why? Because the Japanese government guarantees liquidity for both stocks and bonds. This means that no matter how high you push stock or bond prices, when you need to sell, you don't have to worry about finding buyers. You can always sell back to the Bank of Japan. This means that the investment is almost risk-free.
But a problem arose in 2020 when the US started printing money and US government bonds, or treasuries for short, reached new highs. Their value began to fall sharply. Within 5 years, treasuries experienced a bear market, meaning their value continuously declined. Treasury interest rates rose from 1% to 5%, but fewer and fewer people bought them. Why? Because if you buy at $140 today, tomorrow it could drop to $94. If you sell, you lose money. If you don't sell, you have to wait 10 years to get your money back. Who would dare to buy in such a situation?
More importantly, in the past, the majority of treasury holders were Americans themselves. They printed money and borrowed from themselves to spend. Previously, 65% of treasuries were bought by Americans, meaning only 35% were bought by other countries. But currently, this proportion has dropped to 21%. Even Japan, which used to be the largest buyer of treasuries, has stopped buying treasuries. China and the UK are no longer buying treasuries either. Although the Federal Reserve has lowered interest rates, treasury interest rates have not decreased, instead they have increased. Currently, treasuries are offering a 5% interest rate, a very high yield.
Previously, other countries and investors would compete to buy treasuries, but now, even with high interest rates, treasuries are difficult to sell. Not only are they not selling, but many countries are continuously dumping treasuries. The ultimate result is that the Fed and American capitalists are forced to buy back these very treasuries. Therefore, many conclude that the Fed will have to expand its balance sheet, print more money, and buy a large amount of treasuries. This will make the value of treasuries rise again. Is this true? Yes, the Fed will expand its balance sheet and print more money. This aligns with my prediction because the US government has no more money to spend. But whether treasuries will truly recover strongly is another story. As I've said, currently the whole world is dumping treasuries. If the Fed tries to lower treasury interest rates to 2–3% and sell them at a higher price than before, what will happen? The result will be that treasuries will be even harder to sell and will be dumped even more by other countries. At that point, the Fed will be forced to use more money to buy back treasuries. This is why I believe that from 2025 onwards, an era of hyperinflation will begin. The Fed's money printing speed will accelerate. Previously, it might take a decade to print once, then it shortened to 5 years, then 3 years, and now it could be just 2 years or even 6 months at a time.
Treasuries will become increasingly difficult to sell. Only if the Fed continues to buy treasuries will there be a short-term recovery, because the Fed will temporarily inject a large amount of money to buy. But to say that treasuries have escaped the bear market and returned to the bull market, I find this very unconvincing. The only way to change this situation is if Donald Trump is re-elected and, as he has declared, launches a global trade war, making the world economy even more chaotic. When the global economy weakens and investments worldwide lose money, people might return to buying treasuries. I believe Trump will do this, but are you sure he will succeed?
Conclusion: the only safe asset in the storm. Currently, what we can be sure of is that the US's money printing speed will increase and the US dollar will enter a period of depreciation. What are the consequences? Before the 2020 pandemic, I could use $10 to eat a KFC meal. After the Fed printed unlimited money, for the same KFC meal, I had to pay $20. This means the Fed has directly taken money from our pockets, using our hard-earned savings to help the US pay its debts. Therefore, for me, the best risk hedging asset has never been treasuries. Or you might not believe my words, but try to see what other countries have been investing in recently. The answer is only one: gold, because gold is something the Federal Reserve cannot print. 20 years ago, to extract 1 ounce of gold, you needed to remove 1 ton of rock. Now you need to remove up to 7 tons of rock. This means the cost of gold mining has increased 7 times.
But we have always been indoctrinated with false ideas. For example, Warren Buffett always taught that gold has no investment value. For the reasons why, you can refer to my previous videos. US textbooks also taught that gold only has value during wartime or the apocalypse. At that time, I didn't understand. If there was really a war, even if gold increased in value, what good would it do to hold gold? Exchange it for food? Wouldn't you die faster? So what's the truth? In war, what really increases in value is food. As for gold, since 2000, when the US began to lower interest rates, gold prices have increased 9-fold, while the S&P 500 US stock index increased 30 times. If you still believe that the gold is only a bear market asset, then why, during a bear market, did gold prices rise higher than even US stocks? If you believe that the US dollar will increase in value in the future, then don't buy gold, because then you'll need fewer dollars to buy more gold. But on the contrary, if you are like me and believe that the future will enter a period of massive inflation and the US dollar will continuously depreciate, then gold is the best risk hedging asset, because in the future, you will definitely need more dollars to buy less gold.
For me, as soon as I earned $1 million, I use 1/5 of that money to acquire physical gold as a long-term risk hedging asset. Sometimes, when gold enters an uptrend, such as early last year, I also allocate a portion to gold ETFs or use leverage to invest in gold futures to capture short-term profits from the trend. When other opportunities aren't present, we find gold to be one of the rare assets exhibiting the breakout growth pattern we've studied. Currently, the risk we bear when buying gold is only about 2%, but once the price of gold rises, it can break through previous highs without limit. This is the profit-to-risk ratio. Some people live to sleep better. Some live to awaken. Currently, the situation seems peaceful, but it's always like this before a storm. In fact, the US stock market has begun its second correction phase. Tonight will be the time for Trump's comeback, and the situation is predicted to become even more chaotic. But for us, such chaotic times are precisely when more money can be made, because when one asset drops sharply, capital will shift to another asset. Risk always comes with opportunity, and all the crises that we as investors and entrepreneurs observe, I will share with you one by one.
What do you predict will happen next? Due to time constraints, I will end here. We share free information on how to become wealthy, an entrepreneur, an investor, and achieve financial freedom. If you don't want to miss out, follow my channel and turn on notifications. Don't hesitate to share this video with everyone. I sincerely wish all of you who have liked this video to achieve financial freedom soon. If you find just 1 or 2 useful insights from what I've said today that help you improve your life, I will be content.